the next driver for these markets sitting pretty close to record highs, given that feels like for a long time we've been talking about the reflation trade, the vaccine rollout-driven trade?
So I think one of the things we've been looking at are the global asset allocation strategies of some of the world's major funds. So sovereign funds like Norges, big pension funds in the UK, for example, Universal Superannuation Scheme, CalPERS in the US. And one of the things that we've discovered is that many of these big funds have very tiny exposure to China in particular. And I think that's a bit of a disconnect when you look at China's place in the world economy. IMF data is telling us that by 2028, the Chinese economy will be the same size in US dollar terms as the US economy. And we think that global investors need to reconsider how they allocate money to Asia and in particular China. So that's the big theme that we're looking at right now.
So for China, what are you liking in particular? Obviously, the tech sector, there's a lot of uncertainties, but still huge opportunities, you would imagine, there as well. You're saying stay away from financials. What are the kind of, I guess, lower risk but still high growth potential sectors that you would be looking at?
Okay, so one of our guys in Singapore, Chetan Seth, who's our head of strategy for the region, he's been looking at 21 stocks that he's identified out of the Asia region in general, excluding Japan. And in particular, he's seen that companies like Tencent, Alibaba, which are your major tech plays, are actually inexpensive on something called a PEG ratio. So we take the PE divided by the potential growth. And companies like that, we think, have got decent returns in terms of a growth-adjusted value play. So we're very comfortable with these names. But even in the bank sector, I was talking to our financials analyst, Cheng Bo-Tang, this morning, and what he said to me is that if you look at Chinese banks like ABC, China Commercial Bank, these companies have got rock solid dividends. And in the context of global bank valuations, Chinese banks, again, are inexpensive. So I think what we've seen is that a lot of global investors are guided by the MSCI or the FTSE benchmarks and therefore don't have to pay too much attention to China. But if you are a genuinely rational investor and you look at China's place in the world, then I think these stocks would get more scrutiny, and that's when valuations would actually adjust towards developed market levels.
To your point, China's place in the world, this GTV chart on the Bloomberg showing China's GDP as a percentage of the U.S. GDP, and it's topping 80%. And estimates are that in a few years, it will actually equal the size of the U.S. economy. When you look at investors getting into the Chinese market, whether it's institutional investors or, say, pension funds, how much exposure do they have to China?
Well, if you look at Norges, which is one of the top 3 sovereign funds around the world, so Norges in Norway, you got NPS in Korea, GPIF in Japan. Norges specifically has 3% of its equities portfolio in China. So it's a very, very tiny percentage. And I think a lot of these asset allocation decisions are guided by the index providers. So MSCI, for example, and MSCI has a category for all of Asia ex-Japan, and a mix of that is in something called emerging markets. And I would argue that given the scale of China, and if we take the next, let's say, 6 years, which will see China and the US reach parity in terms of overall GDP, then it's probably time for these index providers to create a new index for China in the same way as we have one for Japan.
Let's talk a little bit about Japan, because you've actually updated your target from 30,000 to 32,000 last week. We're very close to that 30,000 level for the Nikkei 225. At the same time, though, when it comes to vaccination news, Japan is really lagging, not to mention that we do have a few technical indicators perhaps showing that cyclical rally that we saw in Japan may be a little bit stretched. Your thoughts?
So I think a couple of factors we have to be mindful of when you look at Japan. If you take Japan's earnings, they're quite international. So 50% of earnings for Japanese companies come from outside of Japan. Be mindful that for Japan, China's its biggest global global trading partner, and also US economy has a big influence on Japanese companies. Many Japanese companies have assets in the US, for example. So the fact that we got this big fiscal policy support in the US will lead to earnings upgrades for Japan. And we had the Tankan survey published by the BOJ last Monday, and we saw the overall confidence levels of Japanese companies is at the highest level since 2013. So I think what we're seeing with Japan is we've got momentum because earnings have been very strong. We've also got a government and big business which is more supportive of foreign ownership of Japanese companies. We saw that with Toshiba last week. So I think there is overall a better appetite and a more, let's say, open appetite towards foreign investors participating.